Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary, and today we're going to spend just a couple of minutes together just talking about headwinds that the market has been experiencing this month of September, as well as future headwinds that we see as very possibilities for the market. And so if you're familiar with headwinds, I'm familiar with headwinds. I enjoy riding my bike, I do triathlons, and I can tell you that headwinds make anything that you try to accomplish on the bike a whole lot harder. And it seems that you have to continue to work harder and harder, and as you do that, you're still going to move less and less. And so it creates the need for additional effort. And if you stop moving forward, you actually wind up sliding back. Okay, that's the way headwinds work. Well, headwinds work the same way in the market, and that's really what we're seeing over this past month. We've been in a period of sell-off and pullback really since September 2nd. So essentially the entire month we have seen the market contract and pull back. Very expected. We had been talking for weeks about the fact that we were overvalued, overextended, overstretched, and that a pullback had to happen, that it was imminent. It's happened. We're seeing the sell-off that we have seen so far. There's really nothing out of the ordinary, nothing really concerning. Honestly, just trying to take us out of some of those overbought conditions that we saw. So, but the question remains in terms of the future, what do we see? And we do see that there's going to be additional headwinds that the market's going to have to get past. And the thing about what we're seeing too is that the market is requiring more and more to move less and less. And so those are concerns that the market may be at least temporarily reaching a point where it's almost becoming overexhausted. This here just showing price action movement of the S&P 500. So you can see way up here, that was our market top back in September 1, and then our sell-off as we have begun here. And so this would have been over the last month, and you've seen it's really just been a gradual drawdown. These are our moving averages. This is our 200-day moving average, our 50-day moving average. And so remember, at the height of this, we were trading 2 standard deviations above our long-term moving averages, and I knew this was not sustainable when you look at the technicals. So moving averages act like a magnet. So they draw us either down if we trade too far extended above, or they will pull us up if we're trading too far below. That's the way averages work. We have to trend them over the long term. And what happens is when we get too far deviated either way, there's always a swift reversion at some point. It kind of catches us off guard. We're not really sure what the mitigating factor was going to be, but it happens, and then all of a sudden, and unfortunately with a pullback, it can be more painful when it happens that quickly. And it's been a little while since we've had a significant correction over 10%. The NASDAQ was actually down over 12% last week. And so, but you can see that we have, here we broke through the 50-day moving average. Now, one of the things that we're watching is the fact that we've had a very tough time trying to close above our 50-day moving average. So averages work as lines of support, so they can give us a little bit of reassurance. They also act as lines of resistance. And so right now you can see we've bounced off of the 50-day moving average a couple times. We've not been able to close above it since this has all started. So we'll have to see where today's price action leaves us. But we've been watching that the market seems like it's kind of running out of steam, that it has hit that line and bounced off, but has been unable to close above it. And so we need to watch that, because the next line of support down would be this line here, and that would represent about another 7% decline to there. And so that would essentially be kind of like the next big risk to the market, is could we see an additional 7% sell-off? And it is possible at this point with what we're setting up in the market, what we're seeing. So just thought this was a good way to kind of show you how these averages are working as support as well as resistance. You can see the orderly sell-off that we started with back in the beginning of the month. And then this chart here is just kind of showing that we've really been in a consolidated area as the sell-off. Again, nothing out of the ordinary. We were expecting this. We had been saying again for weeks that this was likely coming. So everything about this is happening. I still know that it can be painful to see these reversions as they happen as quick as they have. One thing I want to point out, so this is relative strength up here of the market. We track relative strength as signs for us that the market is kind of turning back either negative or positive, and it kind of gives us that reassurance that maybe we should consider either taking new positions or adding to our positions. And so you can see way up here as we were in those overbought, overextended areas right before the pullback. Now here's our relative strength here. We really want to see relative strength break above 50. We haven't done that during this latest pullback, so we're watching that. So you can see the last time we were really below 50, this was back in March. So you can see how relative strength dropped at that time and then picked back up. And you can see these overbought conditions that we were in prior to that. And so, you know, relative strength, it kind of allows us to, it's kind of like a signal like, hey, momentum in the market is beginning to shift. It's an earlier indicator. So we're looking at that to see, using this pullback to be able to add additional positions. But again, you don't want to do it too early because the catch-22 is trying to navigate not catching a knife while it's falling. And so that's the idea. So relative strength kind of gives us that extra reassurance that, hey, things seem like they're turning around and momentum is shifting. So that's just another thing that we're watching. Right here, though, what we're seeing forming, it's called a megaphone in the technicals. And again, it's just a sign that the market could see additional selling pressure. The fact that we have been unable to break out of these areas and that our highs are lower, new highs, as well as we are going further down negative on our down days. And so not saying that we're definitely going to see a correction down to the 200-day moving average, another 7%, but we could. And so these are things that we're watching, is why we're still being fairly cautious about adding new positions just yet. We have some on the sidelines that we're waiting to be able to add, that we're ready for. But we do have some concerns about some additional headwinds for the market that I just wanted to talk about. So, you know, one of the things that we've been saying all along is that markets are very overvalued when you look at corporate earnings. And because while corporate earnings, while the economy is not the stock market is tied to corporate earnings. Okay, so they do play a pretty close role. So this is really interesting. These were S&P 500 estimated earnings January 2020. Okay, way back before we'd even heard of that thing called COVID. And so now these are, as you can see, the estimates have come down quite a bit. And so now estimates for S&P 500 corporate earnings are down almost $30 a share. And of course, that's not unexpected when we think about what the pandemic has done and closures and businesses needing to make a lot of changes in their operations. Okay, but this is the point, that we still are not beyond all of the uncertainties, all of the challenges. We are now kind of unpacking and digesting exactly what some of these implications have been. And so, you know, I think that a major headwind for the market is the fact that it really, it looks like, number one, we're probably not going to get additional stimulus, at least before the election. The market is very greedy. It really wanted that stimulus. Why? Because a lot of that money was going right back into the economy and to the market. And so that well seems like, at least for now, it's been dried up. Number two, the fact that the Federal Reserve has basically all but said, we're not pulling out any more aggressive intervention. It's on you, Congress, to come up with a stimulus package. They've punted the football back to Congress, saying there's really nothing else that we can do. And so the market was really intent on waiting to hear the Federal Reserve say that don't worry about it. We're just going to keep being aggressive with propping things up. And so the Federal Reserve has really taken a little more of a step back at this point. And I think that the market is a little discouraged about that. You know, unemployment still remains at all-time highs. I'm sure that you heard yesterday Disney announced they are laying off 28,000 employees. And it's taken up to this time for them to have to make that decision. And unfortunately, I think that there's other companies that could very likely follow suit with that, you know, they've been trying to figure out how to kind of make things work, and they're going to have to make cuts again. So, you know, we look at all of these headwinds that the market still has to get through. Did I mention that there's a presidential election coming up? Presidential election that could possibly end with contention. And so these are all things that the market is going to have to overcome. And so to watch it kind of running out of steam right now, I'm not saying that you should be out of the market, that you should pull out, that you shouldn't participate. I'm saying, though, that you really, this is the time to be a little cautious, to make sure that you're being prudent. This is the time that maybe you trim some holdings, maybe you raise a little bit of cash, maybe you just add some hedges to your portfolio, saying, you know what, next 45 days or so, maybe we should wait and, before I add any more new positions. These are things that you can be thinking, again, just to be a smart investor, to kind of look at some of the writing on the wall. Who knows? Nobody has a crystal ball. So I think that it's just important to make sure that we have at least a good understanding, though, of what the technicals and the fundamentals are showing us, and then kind of making decisions based upon that. In terms of our tactical allocations, they're still holding up very well, even despite the pullback. So we are very comfortable with the areas of exposure. Again, that's just the reason why choosing areas of positive relative strength, positive momentum, that's where that's the benefit, that we can kind of avoid those laggards. And when we get on the other side of this, we expect those areas, just looking at their technicals even now, what they're doing, we expect that they will do extremely well once we're through this next pullback. So again, that's really what I wanted to get into today, and just to make sure that you're being prudent, that you're being cautious. You understand that the market's going to have to get through some more headwinds over these next couple weeks at least, and then we can kind of see where we get out on the other side. I'm always available for questions. For if you wanted to shoot me an email about a question that you have, I'm always here to help. And so thank you for joining us, and look forward to meeting with you all next week. Have a great night. Take care.